Hey everybody, it's Ron, and I want to tell you a story about business and how that story changed everything. Just a quick heads up, today's episode is going to be a little different. I want to use a specific event in history to open the door to a phrase you've probably heard thrown around for decades, especially in election years, without maybe ever getting a clear answer on what it actually means, how it's supposed to work, and why smart people still argue about whether it works at all. That phrase is trickle-down economics. It's sometimes called supply-side economics. And hopefully, by the end of this episode, you're going to understand it better than most people who use the term without ever looking underneath it. But to get there, we need to start on a ranch. On the morning of August 13th, 1981, reporters and photographers gathered on a dusty hillside at Rancho del Cielo, which is President Ronald Reagan's private retreat above Santa Barbara, California. Reagan had flown out from Washington, D.C. specifically to sign this bill somewhere that felt like on his own ground rather than a formal room back east. And the image mattered every bit as much as the ink on the bill. A cowboy president in an open collar shirt signing away the largest tax cut in American history up to that point from a wooden table under an open sky, not a marble desk under a chandelier. The bill itself was formally called the Economic Recovery Tax Act, but almost nobody would remember it by that name. What Reagan signed that day cut the top income tax rate from 70% down to 50%. It slashed capital gains taxes, and it reduced what corporations owed too. All of that built on a theory that President Reagan's own future vice president had mocked just 18 months earlier on the campaign trail as voodoo economic policy. So which is it? A serious defensible economic theory or a phrase clever enough to make an unpopular idea sound inevitable? That's genuinely still being argued today more than 4 decades later. So what does the theory actually claim happens when you cut taxes at the top? What did its own architects privately admit about why they were selling it that way? And how did one signature on one ranch on August 13th, 1981, turn into an argument that still shapes how the very political system talks about wealth, taxes, and growth today? From Business Basics, I'm Ron Trucks, and this is Business History, the daily podcast where we explain the stories that changed business forever. Every date on the calendar has a story where business reshaped the world. Today, August 13th, that story takes us to 1981, the argument that was never settled. To understand why President Reagan's tax cut happened at all, you have to understand the mess it was trying to fix. By 1980, the American economy was stuck in something economists call stagflation, which is high inflation and high unemployment happening at the same time. That's a combination standard economic theory said basically shouldn't occur together. Prices were rising fast, but jobs were scarce, and the usual playbook for fixing one of those problems seemed to make the other one worse. That backdrop is what made a genuinely radical idea suddenly seem worth trying: cutting taxes sharply during the downturn instead of raising them, which is what would normally happen. Before getting too much further into this, it helps to actually define some terms, so let's talk about them. What's called a top marginal tax rate of 70% doesn't mean the government took 70% of everyone's income. What it means is that rate of 70% applied only to income earned above a very high threshold, the last dollars earned by the highest earners, not the first and not everybody. Also, we need to talk about capital gains taxes because those are different still. They are a tax owed specifically on the profit from selling an investment or a stock or a business or a piece of property, which is separate entirely from the taxes that show up on a paycheck. So if a business had bought a building for $250,000 and then sometimes later sold it for $350, the tax that they paid on that extra $100,000 that they gained on the value of that property would be taxed at a very different rate. Okay, back to our story. The theory behind cutting both of those tax rates came from an economist named Arthur Laffer, and it was also championed in Congress by Representative Jack Kemp and Senator Bill Roth, whose name might sound familiar from 401k Roth plans. Laffer's idea, often sketched as a simple curve on a napkin, was straightforward in concept. His concern or theory was that a tax rate can climb so high that it actually discourages the activity that's being taxed: working, investing, selling an asset. That means a lower rate could, in theory, encourage more of that activity and ultimately end up generating just as much or more total government revenue from those taxes. As we started off with mentioning, on the morning of August 13th, 1981, Ronald Reagan signed the Economic Recovery Tax Act at Santa Barbara, California, choosing that setting very deliberately. He sat at a wooden table under an open sky instead of a formal desk in Washington, D.C. By placing his signature on that bill, the top individual tax rate would be cut from 70% to 50%, lowering how much those very high income earners would pay on the very highest part of their income. It would also cut the capital gains rate from 28% to 20%. It also reduced what corporations owed as well, because ultimately business and corporations are the ones who usually face the capital gains taxes the most. One other thing I want to explain about that corporate piece, because it deserves a little bit more in-depth explanation, since it's often the least understood part. The law that Reagan signed also introduced a new system letting businesses write off the cost of equipment and buildings and property much faster than they had before. In plain terms, a company buying new machinery could reduce its taxable income for that year much quicker. That would free up cash earlier that, in theory, could be reinvested into expanding the business's operations, hiring more people, purchasing more stuff, rather than that money sitting locked up for years. On top of all of this, or I guess I should say after all of this happens, comes a moment that reframes everything that actually came before it. Just months after Reagan signed the tax bill, David Stockman, Reagan's own budget director, the man responsible for actually running all these numbers, gave a strikingly candid magazine interview. He admitted that they were using the supply side language, in his words, as a way to sell something harder to say plainly, telling the reporter it's kind of hard to sell the concept or explanation of trickle-down. So using the supply side formula language was the only way to get a tax policy that was really trickle-down. That's a pivot point of this whole story. It's a rare moment where someone who helped build the policy openly acknowledged that the public explanation and the private goal weren't quite the same conversation. What happened next in the process or in the history depends genuinely on which numbers you choose to lead with, and both sides have very real numbers to talk about. Supporters of the tax cuts for the wealthier people point to this. Government revenue after the capital gains tax cut rose from $12.5 billion in 1980 to over $18 billion by 1983, then climbed past $80 billion by 1986. That's government revenue from the capital gains tax. Also, unemployment and inflation both fell sharply through the mid-1980s. To supporters of the tax cut, that's the theory working close to what was promised. Lower rates, encouraging enough new activity to eventually raise total revenue and strengthen the broader economy. Critics of the tax cut point to this. The federal deficit, which is how much the country spends more than what it brings in, exploded in the years that followed, peaking at $221 billion by 1986. While some of the tax sources did increase, the cuts were designed for relief to the normal American so that they could make more and purchase more. That would make all of the taxes ultimately increase. Because that effect didn't actually trickle down to the average citizen, the highest earners benefited, but not everyone else. The federal deficit, which grew so huge, became the largest peacetime deficit expansion in American history up to that point. So, to the critics, that's proof the promised revenue growth didn't come close to covering what the actual cuts cost. And that other factors, falling oil prices, interest rate policy, plain economic recovery timing, deserve at least as much credit for the improving numbers as the tax cuts themselves. Now, here's something else worth knowing. Reagan himself, facing that huge deficit of overspending, signed into law a significant tax increase on everyone just a year later in 1982. Basically, he reversed roughly a third of the 1981 tax cuts by raising taxes across the board instead of where the cuts originally happened. Supporters call that a responsible correction. Critics call it Reagan quietly admitting the original math hadn't worked. Both readings get argued in good faith all the way up to today. See, economists still disagree more than 4 decades later on how much of the 1980s recovery actually traces back to this law specifically, and how much of the deficit growth and the long-term wealth concentration in the top 1% traces back to it as well. Neither side has fully won that argument, and neither one is likely to. One signature on one ranch on August 13, 1981, didn't settle a debate. It just gave that debate a name people are still using today: trickle-down economics. I'm Ron Trucks, and this is Business History, the podcast that finds the turning points behind the headlines. To hear more stories like this, follow us on Apple Podcasts, Spotify, YouTube, or wherever you listen. And if you're enjoying the stories, please don't forget to subscribe and leave a quick review. It helps more people find the story behind the business. And if you want to actually understand business better without the fluff, the buzzwords or the MBA language, start by visiting businessdailypodcast.com.